I'm Ron DeLegge with ETF Guide TV. We're pleased to have with us Lance McGray, Managing Director and Head of ETF Product with Advisors Asset Management. Lance, welcome to the program. It's great to catch up with you.
Thanks for having me, Ron.
Let's begin by talking about growth stocks, which, as you know, the tech sectors led the entire market. And as a relative comparison, growth has outperformed value stocks over the past 1, 3, and 5 years. They're doing it again in 2020. However, some people and some observers believe that, listen, at some point, this trend of growth over value is going to come to an end and that there's going to be a leadership change. How do you see it?
Yeah, absolutely. We agree. I mean, you mentioned the fact that the growth securities have outperformed value securities 1, 3, 5 years. You can actually even take that back to 10 years. And if you look at, the Russell 1000 growth versus its value counterpart, it's actually outperformed it by 250%. And when you think about that on an annualized basis, we're talking 8% a year. So that is something that is, it's certainly a deep hole that value securities have sort of put themselves in over the last 10 years. But what's really interesting is the conversations, are starting to change. 10 years is a long time, and there's a lot of investors, a lot of professionals that quite honestly don't remember what it was like when value was leading the charge because it has been so long ago. Yeah. But if you look back 50 years or so, there have been a number of instances like these where it's gone value and growth, value and growth, value and growth. Now, obviously, none have been as drastic as this. But to think that the growth trend is going to continue might be a little stretch, although it has been hard to ignore the Apples of the world, the Microsofts of the world, and go against those stocks. But it's really looking for that catalyst that's going to drive that value. What's going to bring that sort of valuation gap, performance gap back in line? And, the way that we look at it is there's really two things that we're keeping a close eye on. Number one is, as I mentioned, valuations. Yes, rates are low, interest rates are low, but that has the ability to extend the multiples a little bit. But when you're looking at growth versus value, obviously growth strategies or growth stocks tend to trade at a premium over value. But in the recent months, it's been essentially 2x that of the valuations of value stocks. When in reality, or when in history, that's closer to 12, 13, 14%. The other thing that we're really looking at is good news on the COVID front. If there is more news around a potential vaccine here in the fall, that may be the catalyst to get the value securities up and running and close that disparity gap rather quickly. So those are really the two catalysts that we're looking that could potentially change this 10-year trend that we've been in.
We've seen, as you know, Lance, a drop-off in stock market volatility. And usually it's the defensive stocks, those value-oriented stocks that tend to do a little bit better in choppy markets on a relative basis versus the growth stocks. So the question is, how do investors position their portfolios to capture both trends, growth and value?
Yeah, so what's really interesting here is, as you mentioned, growth has a perception of being riskier. In this environment, it's been kind of a flip-flop. Growth securities actually have a lower beta and lower volatility to the broad-based markets. So it certainly has added sort of, thrown a curveball for most investors. But to your point, how do you sort of capitalize on, how do you invest in both growth and value? And what we really talk about here at AAM is almost like a rheostat, right? One of the hardest things that you can do in investing is time anything. And one of the hardest things you can do is actually time factors in the market. So What we really talk about is, using that rheostat, dialing up, dialing down exposure, not making any drastic allocations, going from 100% growth to 100% value. But really, if there is an area that you want to capitalize on or an exposure that you want to get to, dial it up and dial it down. We say it again at AAM, you miss a little, you miss a lot. So one of the ways that you can, not miss something is be invested in it. And one of the easiest way to do that is have a little allocation to value, even in this environment, where if that trend does, tend to change, you have exposure to it and you don't miss it from the beginning.
Yeah, those are some great points. Now, One of the less understood things that we've talked about off the air, which I'd like to share with our audience, is an idea that you can diversify within strategies. For example, you can diversify within value, and you call it a diversification of strategies. Tell us more.
So we at Advisors Asset Management, we have a whole suite of high dividend values ETFs. And, we hear it often. It's like, okay, I'm going to be tilting towards value, right? I think the valuation gap, and, I'm going to take some profits off the table. I'm going to invest it in value. But when you look at it, there's a few things here. Number one is there's over 60 ETFs in the US that have value in the name. So first thing first is when you're looking to make a change into an ETF or any vehicle for that matter, you really have to understand what's under the hood. Because those 60 ETFs, I can assure you, they are completely different, not completely different, but they have major differences in the way that those portfolios are constructed, and they have major differences in the actual exposure that you're getting. So even though you're investing in a quote unquote value ETF, make sure you understand what exposure you're getting, making sure that it's in line with your goals and the outcome that you're looking for. Now, in terms of
look beyond the label.
Exactly, because I must admit, a lot of sponsors, a lot of ETF providers are getting very creative in the way that they name their ETFs, their naming conventions. So as an investor, make sure you work with a professional. Make sure even a lot of ETF sponsors have the ability to show you what does this product look like in one's portfolio? What type of changes does it include to your, in the equity world, we often talk about market cap diversification, security diversification, geographic diversification, but also don't forget about factor diversification, because there are ETFs, broad-based value ETFs out there that actually hold 70% of the names that are in the S&P 500. So if you're looking for a slight tweak into value, a portfolio like that might be a good way to go. But on the flip side, if you're looking for more of a deep value type strategy, you can look at a product like ours, which has 13% overlap with other value ETFs. So that gets me to my other point is sometimes value ETFs, they complement each other very, very well. And this is why it's so very important to look at the underlying holdings and see how they interact with each other and what that means for the total portfolio composition.
Let's talk about financial professionals, and this will be our last question for the day, because I know you got to get back to your work and activities. We appreciate you taking the time, by the way. But financial professionals like to know what their peers are doing. And I think this continues to be illustrated in that just a ton of interest by advisors in dividend strategies. A lot of that, of course, is client driven. If advisors are interested in that, it's because their clients are interested in that. So what are you seeing trend-wise with how professionals are allocating their investments, their client investments?
So it seems like, as we briefly touched upon earlier, it seems like more and more financial professionals are starting to look at valuations, and they're starting to have, worries that, it may be getting stretched. It may be, the time to rotate, take some profits off the table, rotate it into value strategies where that dispersion gap has pretty much never been wider. And 6 months ago, it was very challenging finding individuals, financial professionals that were open to having the value conversation. But that seemed to have changed over the last few weeks, and certainly weeks, but possibly even months. And we're seeing more investors, more and more ETF investors thinking about the rotation out of growth into value, or some sort of migration, if you will. And when you really look at the flows, the flows that were reported, just a few days ago, we can see that. And that's one of the things that we look at, and to give us some sort of investor sentiment. And that's one of the beautiful things about ETFs is that you can attract, you can actually follow the flows of investors and what's happening with ETF investors. And over the last month, we've actually seen that. We've seen, pretty much growth strategies are on pace for their worst asset raise, actually, outflows, 2.1 billion since January of 2019. And on the flip side, we're looking at value and dividend strategies And so far this month, about 26% of the flows that have come into the equity space has really been focused on cyclical and value style products. So as a whole, we're starting to see a shift. Now, the performance gap really hasn't been there, but we are starting to see many more investors take some profits off of or away from large cap growth strategies and allocate it into the value securities in anticipation of a potential reversion to the mean.
Well, this is the great rotation that's underway, and we're definitely going to check back with you on it for an update and to see how it's unfolding. And certainly it would be in line with, as it unfolds, investors becoming more conscious of earnings, more conscious of fundamentals, and probably investors becoming more defensive. So we appreciate, Lance, your insights and taking the time to be with us. We'll catch up with you soon.
Thanks a lot for having me, Ron.
Again, that was Lance McGray, Managing Director and Head of ETF Product with Advisors Asset Management. I'm Ron DeLegge with ETF Guide TV. We'll catch you next time.